You have heard the phrase your entire life. The stock market. On the news, in conversations you were not part of, in the background of movies where men in suits stare at screens and either celebrate or collapse. You always nodded. You never asked the question you were actually thinking. How does it work? Not the surface answer, not the textbook definition, not the version that assumes you already know what a share is and why anyone would want one. The real answer. The one that explains why a company in California going up 3% on a Tuesday afternoon can change how much money is in your retirement account by Thursday. The one that explains who is actually on the other side of every trade you make. The one that explains why the market goes up over time, even when everything in the news says it should not. That answer. Nobody gave it to you. Not in school, not at work, not in the 3 finance videos you watched and then closed after 4 minutes because they started with definitions and ended with confusion. This is different. This is how the stock market actually works. Chapter 1. What you are actually buying. You are 27. Your company just added a 401k option. Your HR manager slides a packet across the desk. She says you can choose between several funds. She points to something called an S&P 500 index fund. She says most people pick that one. You say okay. You sign the form. You go back to your desk. You have just become a part owner of 500 of the largest companies in America. You do not feel like an owner. You feel like someone who signed a form. But ownership is exactly what happened. When you buy a share of stock, you are buying a small piece of a real company, not a symbol, not a number on a screen, a piece of the actual business, its factories, its employees, its future profits, its debt, its decisions, everything. Apple has approximately 15 billion shares outstanding. When you buy one share, you own 1/15 billionth of Apple. That fraction is so small it is almost invisible. But it is real, which means when Apple earns money, you earn a fraction of that money. When Apple grows, your fraction grows with it. When Apple makes a bad decision and loses value, your fraction loses value too. You are not gambling on a number. You are buying into the future performance of a real human organization run by real people making real decisions every single day. That distinction matters more than almost anything else in investing. The people who lose money in the stock market usually do so because they forget they own businesses. They start treating their portfolio like a scoreboard. They buy when the score goes up and sell when it goes down. The people who build wealth in the stock market never forget what they own. They buy businesses they believe in, and they wait. Waiting is the strategy. Waiting is the entire strategy. Everything else is just noise dressed up in technical language. Chapter 2. Where the price comes from. You ask a reasonable question. If a share is a piece of a real company, why does the price change every second? The company did not change every second. The factory is still there. The employees came to work this morning. The product is still on the shelf. Nothing fundamental shifted in the 60 seconds between the price being $147.23 and $147.09. So what moved? The answer is the most important thing most people never understand about markets. The price of a stock is not a measurement of what a company is worth. The price of a stock is a measurement of what the last buyer and seller agreed it was worth at that specific moment. That is all it is. A stock price is not a fact. It is an opinion. Specifically, it is the opinion of 2 people, one who wanted to buy and one who wanted to sell, who found each other and agreed on a number. When millions of those agreements happen every day, the average of all those opinions becomes the price you see on the screen. This is why stock prices move on news. Not because the news changed the company, because the news changed the opinions of buyers and sellers about what the company is worth. A pharmaceutical company announces a drug trial failed. The drug was going to be a major product. Suddenly, sellers rush to exit because their opinion of the company's future profits just collapsed. Buyers disappear because nobody wants to buy something everyone else is selling. The price falls not because the company changed overnight, but because the collective opinion changed overnight. A retail company reports earnings higher than analysts expected. Buyers rush in because their opinion of the future just got better. The price rises not because the company is suddenly different, but because the collective opinion got more optimistic. You are not buying certainty when you buy a stock. You are buying your opinion about the future against the opinions of millions of other people.
who may know more than you, less than you, or simply disagree with you for reasons that have nothing to do with the company at all. That should make you humble. It should also make you patient. Because in the short term, opinions are chaotic. In the long term, reality wins. A company that consistently earns money and grows its business will eventually be valued at what it is actually worth. The noise around it may last months or years, but the signal always wins eventually. That is why long-term investing works. Not because the market is efficient, because reality is stubborn.
Chapter 3. Who is on the other side? You place your first real trade. You open your brokerage app, you type in a ticker, you hit buy. The shares appear in your account 17 milliseconds later. You think about who you just bought from. The answer is more complicated than you expect. On the other side of your trade could be a retired teacher in Ohio who decided today was the day to finally sell the shares she has held for 11 years. It could be a hedge fund in Connecticut executing a strategy that involves holding a position for exactly 48 hours. It could be a market maker, a firm whose entire business model is buying and selling constantly to provide liquidity to people like you, who will hold your shares for approximately 3 seconds before selling them to someone else. The stock market is not one place. It is a network of exchanges, dark pools, electronic trading systems, and individual accounts, all connected by technology that routes your order to wherever it can be filled at the best available price in the fastest possible time. When you buy a share, you are participating in the largest, most liquid, most transparent pricing mechanism ever created by human beings. And you are competing against some of the most sophisticated players in the world. Institutional investors, pension funds, hedge funds, mutual funds, insurance companies control approximately 80% of all stock market trading volume. They have teams of analysts. They have access to data you will never see. They have algorithms that execute thousands of trades per second based on patterns invisible to the human eye. This should terrify you. It does not. Once you understand one thing, you are not playing the same game they are. They are trying to beat each other over days, hours, minutes. They are competing for fractions of a percent on billions of dollars. They are fighting a war you cannot win because you do not have their weapons. You are playing a different game entirely. You are buying businesses and holding them for years. In that game, the long game, the institutional traders are irrelevant. Their daily battles do not affect the 10-year performance of a great company. Their algorithms cannot predict whether Apple will be worth more in 2035 than it is today. Only time can answer that question. And time is the one resource every individual investor has that most institutions do not. Institutions are measured quarterly. You are measured by your retirement date. That asymmetry is your only edge. Use it. Chapter 4. Why it goes up over time. The market crashes. Not once, regularly, predictably, severely. Every decade brings at least one moment where the headlines say the system is broken and everyone who stayed in was a fool, and then it recovers, and then it goes higher. Every single time in the history of the American stock market, every crash was eventually followed by a recovery that exceeded the previous peak. Every investor who held through the crash eventually came out ahead of where they were before it started. Why? The answer is not magic. The answer is not government intervention or Federal Reserve policy or any of the technical mechanisms that finance media talks about endlessly. The answer is human productivity. Companies exist to solve problems and earn money. The people running them wake up every morning trying to make their companies more valuable than they were yesterday. Some fail. The ones that fail leave the index and stronger companies replace them. The stock market is not a fixed collection of businesses. It is a living index of the most productive enterprises in the economy at any given time. The weak get replaced by the strong. The obsolete get replaced by the innovative. In 1980, the largest companies in the S&P 500 were oil companies and manufacturers. Today, they are technology companies and pharmaceutical companies. The index did not stay attached to the past. It evolved. What you are investing in when you buy an index fund is not a specific collection of companies. You are investing in the ongoing productivity of human ingenuity itself, in the permanent human tendency to solve problems, create value, and build things that did not exist before. That tendency has never stopped. Not in 1929, not in 2008, not during wars, pandemics, recessions, or political upheaval. Which means the market going up over time is not an assumption. It is not optimism. It is a bet on the most consistent pattern in recorded economic history.
The only way that bet loses is if human beings permanently stop trying to build things and earn money. That has not happened yet.
Chapter 5. The Crash Nobody Prepared You For. You are 34. You have been investing for 7 years. Your portfolio is $87,000. You built it slowly, transfer by transfer, fund by fund. Then the market drops 30% in 6 weeks. Your $87,000 becomes $60,900. You lost $26,100 on paper in 6 weeks. More money than you earned in your first year of working. You open the app every morning. You watch the number go down. The news is catastrophic. Analysts appear on television to explain why this time is different, why the recovery may not come, why the old rules no longer apply. You feel something that no finance book adequately prepares you for. Not just fear, certainty. The certainty that you should sell, that holding is foolish, that the people selling are the smart ones and the people holding are in denial. That feeling is the most dangerous thing in investing. More dangerous than any market crash. More dangerous than any bad stock pick or wrong decision. Because the feeling is wrong, and it is designed by evolution to feel right. Your brain was built for a world where loss meant death, where the correct response to something going wrong was to stop doing it immediately. The fight or flight response that kept your ancestors alive is the exact response that destroys investment portfolios. The investors who sold in March 2020 when the market dropped 34% in 5 weeks were not cowards. They were human. They were responding to genuine signals of danger with a genuine instinct to protect themselves. They were also wrong. The market recovered fully by August 2020. 5 months. The investors who held through the worst of it and bought more while prices were low came out significantly ahead of where they started before the crash. The investors who sold locked in their losses permanently. This is the central paradox of stock market investing. The move that feels most right at the worst moment is almost always the move that costs you the most over time. The antidote is not courage. Courage runs out. The antidote is understanding. When you understand that crashes are not anomalies, they are features. When you understand that every crash in history was eventually followed by a recovery. When you understand that the pain of watching your number go down is the price of admission for the gains that follow. When you understand all of that, not as a concept, but as a bone-deep conviction, then you do not need courage to hold. You just hold. Chapter 6. The Tax Nobody Explains. You are 38. Your portfolio has grown. You have $180,000 in a taxable brokerage account. This year, it generated $7,200 in dividends, and you sold some shares at a $12,000 profit. You sit down to do your taxes. You expect to pay your normal income tax rate on the gains. You have a good salary. Your marginal rate is 22%. You open the tax software. You enter the numbers. The rate on your long-term capital gains is 15%. The rate on your qualified dividends is also 15%. You calculate the difference. At 22%, you would have owed $4,224 on $19,200 of investment income. At 15%, you owe $2,880. You saved $1,344 simply by holding your investments for more than 1 year before selling. $1,344 that stays in your portfolio. That compounds. That earns returns for the next 20 years. This is what people mean when they say the tax code favors investors over workers. It is not a conspiracy. It is not a secret. It is written in plain language in the tax code that anyone can read. Income from working, wages, salaries, bonuses, is taxed at ordinary income rates. At higher incomes, that can be 32%, 35%, even 37%. Income from investing, long-term capital gains, qualified dividends, is taxed at preferential rates. 0% for lower incomes, 15% for most investors, 20% for the highest earners. The person earning $100,000 from a salary pays more tax on that income than the person earning $100,000 from investments. The system was not designed this way by accident. It was designed this way to encourage investment, to incentivize people to put capital into businesses that create jobs and economic growth. Whether that policy is fair is a political question with no clean answer. Whether you should take advantage of it is not a political question. The tax code rewards patience. Holding investments longer than 1 year cuts your tax rate significantly. Holding them inside a tax-advantaged account, like a Roth IRA, eliminates the tax entirely. The investors who understand this do not just invest. They invest in the right accounts, hold for the right periods, and harvest losses strategically to minimize what they send to the government every April. The investors who do not understand this pay more than they have to, not because the system is hidden, because nobody explained it. Until now. Chapter 7. The Index Fund Revolution. You're talking to your uncle at Thanksgiving. Your uncle has been picking individual stocks for 20 years. He has a system. He reads earnings reports. He follows analysts. He watches CNBC every morning before work. He has beaten the market twice in 20 years. He does not know this. He has never calculated his actual return against the S&P 500 benchmark. He just knows which stocks he picked that went up. He does not count the ones that went down. This is not unique to your uncle. Study after study over the past 50 years has reached the same conclusion. The majority of professional fund managers, people who do this full-time with teams of analysts and access to information unavailable to ordinary investors, fail to beat a simple S&P 500 index fund over a 10-year period. Not most of the time, most years. The Spiva Report, the most comprehensive study of active versus passive fund performance, consistently shows that over a 15-year period, approximately 90% of actively managed large-cap funds underperform the S&P 500 index. 90%. The 10% that do outperform are nearly impossible to identify in advance. And the costs of active management, the fees, the taxes from frequent trading, the spreads, eat into returns even when the manager beats the benchmark before costs. This is why index fund investing became a revolution. John Bogle founded Vanguard in 1975 and launched the first index fund available to ordinary investors. The idea was simple. Do not try to beat the market. Own the market. Hold everything. Let the winners grow. Pay almost nothing in fees. Wall Street called it un-American, a surrender to mediocrity. 50 years later, index funds hold trillions of dollars and have outperformed the vast majority of active managers over every meaningful time horizon. The revolution was not about finding a better way to pick stocks. The revolution was about admitting that picking stocks is a game most people cannot win, and building a strategy that does not require winning it. Your uncle means well. His system feels good. The process of researching companies and making decisions gives him a sense of control that passive investing does not. That sense of control is expensive. Not always, but on average, over time. You nod. You eat your turkey. You do not say any of this. You go home and check your index fund. Chapter 8. The number that builds itself. You are 45. Your portfolio is $340,000. You have been contributing $800 a month for 18 years. You did the math once. Your total contributions over that period were $172,800. The other $167,200 came from nowhere. Not nowhere. From compounding, from dividends reinvested, from share price appreciation, from 18 years of the market doing what the market does when you leave it alone. You contributed $172,800. The market matched it and then exceeded it. This is the thing about compound growth that the graphs in finance books show but never quite convey emotionally. In the early years, the compounding is invisible. Your $50 monthly contribution buys a few shares. Those shares earn a small dividend. The dividend buys a fraction of a new share. The whole thing feels pointless. In the middle years, the compounding becomes noticeable. Your contributions matter less than the growth on what is already there. The portfolio starts to feel like it has its own momentum. The growth in a single good year exceeds everything you can contribute in that same year. The portfolio has become a machine that runs on its own. Your job is simply to not turn it off. Albert Einstein may or may not have called compound interest the eighth wonder of the world. The quote is probably apocryphal, but the math is real regardless of who said it. $10,000 invested at 7% annual return becomes $19,671 in 10 years, becomes $38,697 in 20 years, becomes $76,123 in 30 years, becomes $149,745 in 40 years. You did not add a single dollar after the first $10,000. The market added $139,745. That is not a trick. That is not a special circumstance. That is arithmetic applied to time. The single most powerful variable in your investment returns is not which stocks you picked. It is not how smart your strategy is. It is not how much you know about finance. It is how long you let the math run. Start early. Add consistently. Do not stop. That is the entire playbook.
You have heard the phrase your entire life, the stock market. You always nodded. You never asked the question you were actually thinking. Now, you know the answer. The stock market is not a casino. It is not a machine that rewards the lucky and punishes the naive. It is not controlled by insiders who have already decided the outcome before you log in. It is a system built on ownership, on the collective opinion of millions of people about the future value of real businesses, on the permanent human drive to build things that solve problems and earn money. It crashes regularly, severely, and then it recovers, and then it goes higher. It rewards patience above all else. Patience and low costs and time. The person who understands this does not watch the market every morning, does not panic when the number goes down, does not chase the stock their uncle mentioned at Thanksgiving. They buy businesses. They hold them. They let them. And one Tuesday morning, decades from now, they wake up and check their account. Not because they have to, because the number has become something they once thought was impossible. And nobody told them it was coming.